A warm welcome, salam alaikum. Great to have these gentlemen here on stage. We have a very interesting topic to discuss. Nowadays, tokenization has become a buzzword. Everybody's talking about it, but I think most people don't really know yet what it actually means and how to invest in that kind of like topic or in those sectors that are already ready to use tokenization. So I'm delighted to have this panel here today, and I want to really start to bring us all on the same page, if you don't mind, by asking each one of you what it actually means, your personal definition of tokenization. And maybe we can start with you, Evgeny.
Yeah, absolutely. Thank you, and pleasure to be here. Tokenization is an interesting thing because it has existed before blockchain, before crypto, right? You can put ISINs on top of funds, you can create AMCs and those types of things. But to me, tokenization is probably two things. One is it's creating and adding liquidity to something that has never had it, right? So you can make something tradable or more easily tradable. And the bit that I think is even more interesting is specifically with a blockchain angle, is once you make that asset into something that's transferable, interoperable with other financial asset classes and financial assets, how can you add new use cases on top of it that have never been possible before? Reseven sits in the DeFi sector. We run over $1 billion of capital in the DeFi space, and kind of composability is a big thing for us when it comes to tokenized assets.
Mohamed, what's your definition?
Thank you. I think there's two ways to look at tokenization. It's either you create a digital representation of a real-world asset, and as an example, you could see the Bwiddle fund of BlackRock, for example, tokenization of treasuries, or you go to a decentralized lending protocol like Sky, you bring in your real-world asset, and you take a loan based on that and based on the parameters of the protocol in the native USDS for Sky, for example. So it's either creating a digital representation of the asset or taking a loan using that asset as collateral.
All right, thank you. Peter?
Good afternoon to everyone. Our angle, we are investment and strategic advisory firm, and we're working on the origination side with the project developers or asset developers, or operators, and on the other side with the liquidity providers, with the investors. So from that perspective, there are two ways that, interestingly enough, kind of providing slightly different angle, how to look at the tokenization from our standpoint, which is one as the intermediary representation, which improves the settlement mechanisms, which creates more efficiency in the money flows, and so on and so forth. Where, by the way, and we will hear me talking about it, I think that's where the action is today. And second is the external representation as a way to get access to new pools of capital, like DeFi, and provide access to private markets, because when we're talking tokenization, reward assets, we're talking, of course, about the private markets of the assets which were not accessible. So these are two angles which are different. And from our point of view, where we're focusing more is on that middle office, if you will, applications in our daily work.
And Robert, finally, maybe you can also add what are still maybe misperceptions that you perceive out there about tokenization.
All right, well, thank you, Chair. Well, dear ladies and gentlemen, how do you do? I'm Dr. Robert Barnes, the co-CEO of BPX. I'm here with my co-CEO, Ali Saleeker, and Alex Riarshi, our head of business development. And we're building BPX, a digital securities marketplace modernized for institutions through a single connection to trade traditional and tokenized securities. Because when you ask, Florian, what is tokenization? For us as a humble market operator, it's about bringing access and liquidity to assets, including giant illiquid assets like infrastructure, real estate, and private credit. Thank you very much.
Thank you, excellent. Maybe I go to Peter again with my question about misconceptions when it comes to tokenization. Anything that sticks out to you?
So my favorite topic when it comes to misconception or maybe not realization is to trustless environment, and second is custody. So for any reward asset, as you would know, you need someone to take care of that asset. So let's say, if you will say, let's tokenize this hotel. Someone is operating it, someone is making sure it's maintained, someone is making sure it's actually, there's an insurance, so on and so forth. for any real-world asset, you need real-world custodian who is managing that asset, which means that you have to rely on that custodian making its job, or that asset yield or the value will depreciate. So meaning the custody is extremely important, and it is, I think, underappreciated. The related aspect of the, let's say, same thing is, because we're talking about a real-world asset, the representation means that you have to have understanding of the underlying, what it does really. If it is infrastructure or if it is real estate, it has its economic characteristics. And without that understanding and without the fungibility in those characteristics, you essentially are not creating token representing the asset, you're creating token representing the particle property, for example. And it's a completely different, from our point of view, there's a completely different avenue, which is fractionalized ownership versus token representing the asset, which essentially you're investing into some yield or some appreciation.
Okay, yeah, thank you for that. So now that we got each other a little bit on the same page here, let's move forward to the stack itself. Let's see how is this actually functioning. Let's talk about the custody, the wallet, the interoperability, and also the identity. I think these are the parts that make tokenized markets functioning, basically. And I would like to know, Mohamed, what in your opinion is still the weakest part of the stack?
Right. I think there's three challenges that tokenization faces today. The first challenge is interoperability, because there's a lot of tokenization happening on different systems. And the way to respond to interoperability is either through the use of cross-chain communication network, or for those tokenization under permissioned systems, trying to give broader access to investors to these systems, or simply using the public blockchains. The second issue is how to bring money natively on the chain. And we saw it with digital bonds. I mean, for many of the digital bonds issuances, the part of the repayment of the interest and the principal has been kept off the chain because there's no way how to bring money natively on the chain. And there we saw solutions like central bank digital currencies, stable coins, for example, and especially with the developments on the regulatory side in the US with Junius, in Europe with MiCA, and here in the UAE with the regulatory environment for stable coins, both onshore and in the two offshore places, the DIFC and ADGM. And that brings me to the regulatory challenge. I think tokenization can thrive if we have clarity on the regulation. What does it mean to own a token? How does that interact with the reality, with the real ownership, etc.? I think these are the key challenges that we see for tokenization.
Okay. Thank you. Evgeny, and what is your opinion about the weakest link in the whole stack?
Yeah, I think that the weakest link is actually the why, right? So the tooling always gets improved, the wallets get better and the infrastructure gets better, but why do we need tokenization? And in my mind, there are two different universes that exist and people commingle them. So if a very large institution was to transact with another very large institution and the traditional paperwork and back office processes are very inefficient and you can tokenize it and make it more digital, obviously that's great. But that's a back office innovation, which saves a little bit of cost here and there, but doesn't structurally change anything. So it's not as glamorous as people think. The other why, however, is when you move outside of that and you look at new use cases, you're like, let's tokenize a building or a ship. Well, that's great, but maybe a building shouldn't be tradable intraday. Maybe that doesn't really add any value. So once the asset is tokenized on these, let's say, public blockchains, which is the majority of the use cases, then who cares, right? And who benefits? Is it that it's now possible to borrow with a lower cost of debt against that asset? That's obviously great, but then people who are lending against it, do they fully understand the risk? Because if you open up the market to new participants and you introduce new assets into that market, that will push cost of capital down. But if you have, a random individual lending out their capital and savings against some complex tokenized infrastructure asset on the blockchain, maybe they don't really know what they're doing, and in the long term, they're actually going to lose money, and that's not great. So the why and the utility is very, very important. We, apart from running hedge funds, we run some DeFi infrastructure where other people can deploy their tokenized assets, and we can facilitate liquidity, lending, borrowing, and other financial use cases. And we've worked with BlackRock, for example, where one of their tokenized funds is a part of the vaults, as they're called, which we run. But there hasn't been too much of a pickup in the demand for that asset, because obviously it's a great asset, but most people with capital can buy it anyway. And then those who exist in the blockchain world, well, they are sophisticated enough to buy it, but they have a much higher hurdle for the return that they're pursuing. So unless you create a very clear reason, then the distribution is where things actually break. Because technology gets better every day, every second, but most people struggle at, and how do you answer the why, and how do you get billions of dollars in new capital to come in a sustainable and responsible way.
Mm-hmm. Thank you. Robert, where do you see the weakest links? And maybe you can also elaborate a little bit about what's basically missing for institutional grade tokenization.
Well, thank you. First, I'd like to start with the good news. As you heard from our colleagues, there are lots of technologies out there that do tokenization, and the technology is well proven. What has been missing has been a marketplace with institutional grade regulatory permissions that mean the big money investors, the pension funds, the sovereign wealth funds, the insurance companies can have comfort to participate. We've been missing that until now, and that is what we've been building as BPX. We are fully authorized by the FCA as a traditional and tokenized platform. We're very honored to have been the first trading venue authorized by the FCA, also approved by the Bank of England and the FCA in the UK's Digital Security Sandbox, and through the common law, which has been clarified by the Law Commission, which is independent of the government, the stewards of common law, 800 years of property enforcement. The Law Commission has deemed that the common law can accommodate property ownership rights for digital assets. That means for the first time in 2025, we have an intersection of technology that works, legal foundation that gives trust and confidence, and a marketplace in which you can feel comfortable to participate. Thank you very much.
Thank you, Robert. Petr, same question to you. You mentioned it already before a little bit. Maybe you can also elaborate on the lack of liquidity in terms of a weak link in the whole stack.
So essentially, I will elaborate on the why aspect, because there are really two reasons why to use consider tokenization. One is efficiency of the transactions, and that's, as I said, we see a lot of action all the time. I'll give you an example for trade finance, where tokenization has happened, tokenized deposits specifically. And the second is access to liquidity. Now, when we're talking about the access to liquidity, which is what Robert was talking about from enabling the institutional, I'll give you a slightly different perspective, which is the DeFi currently is roughly 150 billion asset value locked contracts. Wealth management is 150 trillion. That's where the money are. And therefore, in order tokenization to actually make the difference, and at the end, make the difference means make the capital flow into those assets, means you have to target the wealth management, not the DeFi. And that's why you have to build the rails and institutional solutions, which, coming back to what I mentioned, the fungibility, makes sense from our point of view for certain type of the assets. And that's why I probably am a contrarian when it comes to tokenization. I've seen the headline, 150 trillion assets will be tokenized. I don't think so, and I don't even think it is necessary. Some of the assets will be tokenized because it makes absolute sense, and some won't, because there's already a good representation, which is like public equity markets. They work quite well. White-to-border, money market funds, they work quite well. But when it comes, of course, to some other asset classes, which is, for example, being able to get access to a representation of real gold, physical gold, not the derivatives where you don't know whether there's actual gold, or energy assets and so on and so forth. That's why will be interesting. But it will be a process exactly because of being able to fit into the guardrails which are existing for hundreds of years, and making sure that wealth managers, institutional investors are feeling comfortable, which honestly means that there is a legal recourse. That's the core. If there's no legal recourse, if I legally am not protected, then I'm not going to bother when it comes to institutional.
All right, thank you, Peter. Well, now that we have the more abstract part maybe behind us, let's talk about real examples, Mohamed. I know that your expertise is especially in the digital bonds, and maybe you can explain a little bit more and elaborate where you see already real examples, concrete examples happening, and maybe where there are already opportunities to directly invest.
Absolutely, thank you. We've seen and we've rated digital bonds issued by government, by financial institutions, by corporates. Over the last 18 months, there were a few $1 billion of transactions that were done. But the common feature behind these transactions is that they were done mainly to test the technology and to test different parts of the technology. So we've seen, for example, digital bonds issued on platforms that are sponsored by banks on a permissioned blockchains. We've seen digital bonds that are listed on public blockchains. We've seen digital bonds that are denominated and that settle in central bank digital currency. We haven't rated digital bonds that settle in stable coins or use stable coin. We rated funds that use stable coin as a mean of repayment. And a common feature of all these digital bonds is that secondary market liquidity is typically low, and that's because there's generally few parties that are involved in the transaction in order to test the technology. And we think that secondary market is an important consideration and should be developed in order for this market to expand further. The other thing is we've seen bonds, digital bonds issued with an analog twin. So if something goes wrong, then everything is switched back to the real world. And the fact of not using, or the fact that the money stays off the chain, is helpful from that perspective, because you always, you have daily backups that the sponsor of the platform can, for example, use in case something goes wrong. From a rating perspective, for most of these digital bonds, we equalize their creditworthiness with the traditional bonds, because we came to the conclusion that the use of the novel technology, or there are enough mitigating factors for the use of novel technology in order for us to arrive to the conclusion that this doesn't have any implication on the creditworthiness. For the funds, we typically analyze issues like the operational risk created by the blockchain, the risks related to the wallet, the smart contract risk, and these sort of additional risks to see whether these could have an implication on the creditworthiness.
Okay, thank you. Evgeny, where do you see some concrete examples successfully implemented? And I know that your background is primarily DeFi, so...
Yeah, so DeFi is this beautiful world of experimentation and chaos, where what is DeFi? It's basically the new internet technologies rebuilt specifically for financial use cases. And it enables things that have never existed before. Our starting view is that everything in the world is going to be tokenized. When I say everything, I don't mean physical or financial assets. When you have, ChatGPT on your phone, the agent that you effectively are training up, that's technically a token, and some of them are already tradable. Time is something that has been tokenized. So we've backed a project where they basically, imagine, for those of you who use Calendly, imagine that units of your time can be tradable on an open market. Basically, there's a marketplace where you can say, I'm a, let's say, a celebrity, and trade 30 units of my time, and whoever redeems it, I have to, speak to them for 30 minutes. Every piece of content is tokenized. You are now able to lend against streams that these influencers do. And soon you'll be able to trade these things. So everything is being tokenized, and DeFi is this ridiculous land where there is $250 billion of capital sitting in a variety of different use cases, but some of them are literally trading units of time of specific people Some of them are lending against media and IP assets. What's going to happen with this whole, AI agent thing is unimaginable at this point in time, but there are AI agents that are already tradable. So agent got deployed, it does whatever it needs to do with investment strategy, and you can trade the units of that AI agent. There has recently been a competition which someone launched where they have different LLM models running small portfolios, and you can bet on how things are going to go. There is this thing that has blossomed out of nowhere, which is called prediction markets, where if you take a very cynical view, you can call it a next generation gambling platform. If you take a more open-minded view, you can say, well, it's a market where you can bet on anything in the world, and is it going to rain today? Who's going to win the election? What are the odds of something happening? And it creates a marketplace, a very open marketplace, where everyone is incentivized to go and explore and find information. So the more glamorous way of calling it is, the market for truth, which is a bit too glamorous for all, as all crypto use cases are. But these marketplaces are more efficient at predicting election outcomes than election polls. And there are many other use cases like that. The holding company of NYSE ended up making a very large investment into Polymarket, which is the leading platform, at a ridiculous valuation. So the more digital the world becomes, the more likely it is that every single thing that touches our lives will be tokenized, and the first cradle for those financial use cases will be in DeFi, and through that it will mature and it will go into more traditional products that will be available to people in this room and beyond.
Excellent, thank you very much. Robert, your background or your expertise is in real estate and infrastructure and also in gold. Where do you see currently one concrete example of successful tokenization?
Right, well, thank you. Well, dear ladies and gentlemen, I think one of the key messages that we've heard from this conference is that there's a rising demand. If you're an investor into projects that are like infrastructure, giant infrastructure projects, if you have real estate, you're looking to monetize that asset. I guess the other key message I took away from Jim O'Neill, now Lord O'Neill, who came up with the BRICS, is that there's a need for economies to have productivity. And maybe if we go to first principles to lead to an example of success, the role of our markets, of our capital markets, is to convert investment capital into working capital, whether that's factories or increasingly in the UK, that's services, and for the very efficient, low friction risk transfer of assets. As we are moving into digital markets have to be capital markets plus benefits. And there are two key benefits. One is the ability to sell an asset and get the money same day. That increases the velocity of money. And the second feature, which we've added into our marketplace, is not just issuance and trading, but the ability to make an asset eligible as collateral so you can place it and receive cash or liquidity. And the first thing I would observe is when people talk about collateral, one of the great features of collateral is you don't have to worry about the credit of the person providing the collateral. When you have the collateral, you can increase the trust and confidence that you'll be able to either use the collateral or provide the lending. If we take a look at some of the real world examples, I think if we look on the table and you see all those bottles, imagine those are buildings or infrastructure projects. It's interesting to note, like corporate bonds, which are, as you were saying, Peter, these are hundreds of trillions in assets. The average number of trades of corporate bonds in a year is about 0. But when you wrap them in a fund structure, which is basically what tokenization is, isn't it interesting to observe that fixed income exchange traded funds are amongst the most liquid securities that transfer on exchanges worldwide. And when you wrap an asset with a fund and you can unitize it, the units give you automatic fractionalization. The ability to make an asset eligible for collateral becomes very interesting when you come up with standards on how you designate the collateral. And I'd like to give the example, as we were talking about gold. I'm sure many of you love gold, right? What's interesting about gold, in 2019, if all of us had 100 of gold and we pledged it as collateral, we might get 15 in return. But in 2019, how many remember the Bank of International Settlements said in 2019 that 2025, gold for the first time would be deemed a tier 1 asset. That means that same 100 of gold that we have today, when we pledge, we don't get 15, we get near 100. What's the insight? The insight is that we've suddenly released even more economic value from the same asset. So the opportunity for us as a community is that the assets that we have, whether they are real estate, infrastructure, private credit, as an industry coming up with a standardization and a series of objective criteria to increase the eligibility of assets for collateralization. And that is what we're focusing on as BPX, a marketplace as a humble market operator in the center with the highest institutional grade permission, so you can be comfortable as an institution to participate with that trust and confidence in the legal foundation to help get business done. Thank you very much.
Thank you, Robert. Excellent remarks. I'm a gold fan, and I really love that you mentioned that. I think this big rally over the last 9 weeks, certainly there's lots of other drivers, but one of the drivers is that it has changed and is now a tier 1 asset class, right? So moving on, Peter, your expertise is in content rights, in private equity, and you also said energy. Where in these areas do you see a concrete example for successful tokenization?
So I would say that our focus is on yielding assets or assets which are having yield. And I think it's also where the tokenization can bring the first benefits, which is essential because it's creation of economic value. By the way, we did experiment 22 and issued the digital bond, which was essentially tokenized, representing Brazil nuts trade. So represented a deal which was Sharia compliant. And where I'm heading with that. The very interesting part is if you focus on the yield function of the assets, first of all, you take away the speculation. You bring actually measurability in how what that asset does. And therefore, you actually can bring very interesting benefits for the tokenization, because now the tokenization represents essentially those cash flows. But tied with being able to make sure that the underlying assets are locked into that cash flows. And that's why I think one of the biggest opportunities, as Florian mentioned, where we're looking at is energy assets, because there's a huge decentralization of building energy assets, which actually is discussed at this conference as well, but also content rights. And because we're running out of time, I just would like to close my remark with, that's where I think the tokenization action will really happen. So yield, which actually is tied into the asset class trust, as we call it, rather than asset class, where we'll unlock the cash flows into those assets first, and then the yielding function.
Thank you, thank you. So time is flying, we have to hurry up a little bit. I have one question for you, Mohamed. What do you think is the most important factor for tokenization to be able to scale over the next 1 or 2 years? Keep it short, please.
Right. I think bringing money natively on the chain is the most important factor, because without that, I think increasing the velocity of money won't happen, because you can trade on chain, but if you have to wait until your bank open on Monday morning to wire you the funds, I mean, that wouldn't really help to reap all the benefits of tokenization. But then, in bringing money natively on the chains, you have different approaches by different regulators. Some of them said that they don't want to hear about a central bank digital currency. Others are moving in the direction. And stablecoin seems to be a good tool, or fitted well to fulfill that role. But the last thing you want to have is a stablecoin that ends up depegging. And this is exactly the risk that we're trying to tackle through our stablecoin stability assessment. So we developed the methodology, we published stablecoin stability assessment on the top 10 stablecoins in the world that represent more than 80% of the market cap of the industry, to give users and investors additional clarity and an independent view on the risk of depegging of all these coins.
All right, thank you, Mohamed. Last question then to you, Evgeny. You mentioned it already before. You basically foresee that there is entirely new asset classes coming up, and maybe you can very quickly just elaborate a little bit more on it, because I love that fact.
Yeah, of course. So what has become possible with the DeFi world, and the main value add is the composability of different assets and different standards, right? You can trade a tokenized unit of gold, of real estate, of time, of a picture, of music, and it's just the same asset standard. This is the main, kind of the main feature of DeFi, where in the traditional world you can't trade an email into a picture. These are like very different things. One of the most successful DeFi crypto projects right now is the one that enables streamers and influencers to monetize attention, which is the most rare commodity these days, and make their content basically tradable. I know we're running out of time, so I'll leave it there.
Thank you very much. Yeah, it would be wonderful to have more time because we just started scratching here on the surface. Thank you very much to the panelists. It was a pleasure to speaking here with you. Thank you all to the audience. And I think it became clear that this is a big digital economy that is just in the beginnings here. Thank you very much.